Hey guys, this is being recorded. One thing I mentioned at the beginning of every single webinar, and I know a lot of you out there recognize some of those names, have heard this time and time again. And sorry for that, but everybody else probably needs to hear it. Watch this again. It will help you remember it longer if you do it relatively soon. If you wait a month down the road, you're going to forget some of these nuances. And you don't necessarily have to watch this specific one on the implementation of options into a portfolio. You could look at one of the other ones where we've done different courses, and we try to make it a little bit more specific for every single situation. This really is using these options to implement into our portfolio in order to gain yield and throw some stocks in there. And this is a great one if you are considering adding stocks to your portfolio, because you can go out there and easily put a limit order in down below the market, but you're not getting paid for that, taking on that risk if the market moves on you and you get and you buy those. Whereas with the ratio put spread, there is an extra short put in there. Now, a lot of people might get nervous. Oh my gosh, I have an extra short put. That means I might have to buy it at that level. Well, yeah, the idea is if we get a pullback, we'd be more than happy to buy this stock and put it into our portfolio. And you can do that with just the short put also, and you get a nice credit for that. Well, the beauty in this one is you get a nice little credit. It's a credit, and nonetheless, so if you're directionally wrong, the market never really pulls back, you get paid for taking some of that risk. And if the market does pull back, you get that credit, or you get to buy that stock at the level you wanted. And you also get a little bit extra because this put spread is going to help lower that overall cost basis of what you ended up paying for it, right? And I'll explain all of that stuff as we go forward. So this is a nice little strategy that if you think there's a pullback in an underlying, say for instance, you might have missed the Apple move or Netflix's move, and you were thinking, gosh, I wish I would have added Netflix in my portfolio. Well, on a pullback, you'll get paid for that pullback, and you'll be able to buy it at a relatively decent level. So that's what we're going to go over in this webinar, and why that it is important to follow these rules along the line of implementing this into our portfolio. Where are you, Eric? South, north, west, or west? I'm actually southwest. I'm out in Arizona now. It's 85 degrees out here today. I'm sorry for you guys that were getting snow up there in Chicago and up north yesterday. All right, so let me go over a couple of things. When I was in Chicago, I would have had those April snow showers as well, but I've since moved out. But some background around me, I've done stuff on mainstream media like CNBC, Fox Business, Wall Street Journal, and I would do commentary on everything from economic to geopolitical, market analysis. Every once in a while, do some hits for them still, but not quite as often as I was when I was in Chicago. But I've been trading my own money since college. And after graduating with a finance degree in college, I moved straight up to Chicago and started working on the floor of the Board of Trade. And in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products, just about all market conditions too. Please take a moment to go over this disclaimer. It really is saying we are an educational company. I might even be talking about stocks, you guys, that's in my own portfolio. I'm not trying to get you guys to do the same thing I'm doing. I don't believe in that. I don't believe in the herd mentality. I don't believe in giving trade recommendations because I don't know your risk parameters. I don't know what's in your portfolios, and therefore it is not very responsible in my eyes. So without further ado, please remember past performance of any trading system or methodology is not necessarily indicative of future results. John David says he's out in Georgia and it's slightly cooler. Yeah, you're probably getting some of that blast from what Chicago and everything is doing. Why live in AZ in Florida? I love Arizona. We can go over all of the upside to Arizona, but anyway, you can follow me on Twitter at Wolfman's blog, and you can follow me on our parent company at Pro Trader Strat. Also on our Facebook page, we have a lot of content we're throwing out there, so please follow us there so you can get quick access to some of the daily market commentaries and even some webinars every once in a while. All right, like I said, this is the ratio put spread, or the put ratio spread. However, some people say it. I usually just say it's the ratio put spread, because really it's a put spread, but you're adding a little bit more risk with this strategy, okay? So it's not just a regular put spread. Regular put spread, we would know that we would have a 1-by-1. You would, a regular put spread, you're buying one put, right? And then you're selling one put. We used to say it would be a put spread, right? Well, this, we are buying one put and then we're selling two puts, all right? So we're selling two puts on that, which we will get a credit. This one up here, you would get a debit, all right? So you would have to pay a debit for that. You're buying it, and as the market falls, you're trying to make the width of that spread. This one, we're going to make the width of that spread. We do have a little bit more risk here with that extra short put. That's where I'm talking about. It gives you great strike location if you're able to buy it there. And because we'll get paid on the difference between the width of those spreads, that's a nice, juicy credit. All right, you're going to basically do this for a credit. You get to keep that credit, and the width of the spread, you'll get to keep that as well. So when we're talking about like lowering cost basis on something, we would be able to consider that lowering our cost basis by whatever the width of that spread is. And, you get to keep that credit also. So that kind of even lowers it a bit further. We'll go through all of those break evens and everything. And this is a front ratio spread. Yes, think or swim. When we punch this up, it's going to say a back ratio spread. A back ratio spread, you guys, is done for a debit. And it's really where you're buying two puts and then selling one to help finance some of that stuff. So this one is where we are buying one and selling two. So we're adding a little bit more risk to a regular long put spread. But with adding that risk, we have to do it for a credit, you guys. That is, if you take nothing away from this, other than I know that when I do this spread, I have to get a credit, I'm all good with that. There's no reason to add risk to this strategy and do it for a debit, okay? It just doesn't make sense, okay? Make sure that if you're adding risk, you're getting paid for that risk. And if you're doing it for a debit, it's just really not worth doing it. Play around with this, the legs of it in order to be able to get that credit done. How much of a credit? That's a great one. It does, as long as you're getting a credit, is really what is ultimately important. I've been doing, I'm doing a little bit more back testing and stuff like that, trying to find what the real sweet spot is. And really it comes down to, I think it's right around, and this isn't written in stone, but right around, if it's a $5 wide, it's going to be about 60 cents is something that you should be shooting for. It seems to be the nice wheelhouse on it. All right. Because of the two short puts. Yes. The extra short put, you can do a long put spread. Yes, you're going to pay a little bit more debit. But if you're selling an extra short put in there, make sure you're doing it for a credit, because you want to get the full width of that spread. And I'll go through a lot of those reasons. One of the things is it gets us out to usually about a 1 standard deviation move when we're looking at this. It's riskier because of the extra put. Yes. The extra put, because you might have to buy that stock at that level. But at the end of the day, we're going to be looking at this, and it's going to put us at about a 1 standard deviation move when you figure in where our break even is, okay? And that is, yes, you're going to be buying it, say, on a $5 wide. You're buying that stock at $5 wide. Well, the width of that spread gave you an extra $5 credit. So your break even is actually $5 lower than where you got into this underlying. And I'll go through that here a little bit more detail as we go along here. Can we do, yes, you can do this in your IRA. Now, One thing I forgot to mention in the ratio call spread was in an IRA, we need to probably define that risk on that strategy by buying, a call way out here on the option montage. And if you guys I recognize some of you guys from last week, so I'll just mention this. My rule for that one is go out there on that ratio call spread way high, and the first option you can buy for a nickel is the one you buy. And that kind of makes you meet the rules of being able to put it into an IRA. With this one, it's going to be more, I wouldn't go out there and necessarily buy that nickel put, because ultimately it's going to act the same as a cash secured put here. So if you're doing this in an IRA, you're going to have to do a cash secured put. Another thing with this strategy, if we're looking to do this in our portfolio, adding this to our portfolio, make sure you have the money to be able to buy that extra stock, right? So, if you're used to wanting to add a 100 lot to your portfolio, 100 contracts of the underlying, then you're going to want to do this buying one and then selling two. If you wanted to add like a 500 lot, you're going to be doing it a 5 by, a 10. Okay. Because then you've got the $5 spread and then that extra naked put, in a sense, is the 5 lot equaling a 500 lot in the underlying. All right. Another thing with this one, it isn't the best strategy for stocks that are under $50. You're going to be really close to it. There's a good likelihood that you might get the stock put to you, but at the end of the day, it's probably something we want to add to our portfolio. So, it's a good thing. As a normal trading strategy that I didn't really want to add necessarily to my portfolio, I like to stay away from those ones that are under $50. Okay. All right. Does that make sense? This is a 1/2 ratio. Yes. There are 2/3 ratios as well. Yes, there are, John. I only really deal with the 1/2s. I don't really play around with those 2/3s. All right. So our market assumption is neutral to bearish. Obviously, if the market goes down, our put spread, this is where we're buying one and we are selling two puts, right? So we're buying one put up here. We're selling two puts down here. We want the market to come down there and kind of bounce around. So we are neutral to bearish. Well, if the market trades this way, we're okay with it because our put spread, we're down in this area still, right? So if we trade neutral or even higher, say for instance, Netflix, I feel like I missed the move. I'm waiting for a pullback in it. That's something I wish I would have added during the big sell-off. But, I feel like I kind of missed that opportunity. I don't want to be buying these all-time highs. So if Netflix pulls back, then I'd be happy to take that on, right? So those are the kind of ideas that you're coming up with when you're looking at this strategy. So that's kind of your assumption. Yeah, it's made a big move. I kind of want to add this to my portfolio, or maybe you think it's starting to sell off and there's all this terrible news out about the banks and you think the banks are going to be fine. This might be an opportunity to put this in there as well. Whatever your idea is it's neutral to bearish. Why neutral? Because we get a credit, right? So at the end of the day, if we don't get the width of the spread, we still get to keep that credit. And that's another reason why I said, if you're adding risk to this strategy, well, you need to get paid for it. Therefore, if you're doing the credit and the market doesn't go your way, that's a good thing. I'm more than happy to keep my credit of, 60 cents on a $5 wide. It's like I got a dividend in a stock that I didn't know. Why not under $50? Because you're going to have like 50-cent wide. You're going to need like 50-cent wide spreads, and you're just not getting paid a whole lot for it. It's just something I like to stay away from. But if it is, and that's generally speaking for a regular trade, all right? If I was just going to put a trade in there and I didn't really want the stock or, wanted to maybe catch a little bit of a pullback or something like that, but didn't want to add to my portfolio. Those ones under $50, I would probably rather just do the put spread and pay the debit, because you're just that extra put, you're only going to get like 10, 15 cents for it or something like that, maybe 25 cents. And for me, I'd rather just have the defined risk on it, on those lower ones. Well, and with the higher price ones, I can put this strategy on and get a nice little credit to pay me off for my risk. All right, so I've kind of already mentioned this a little bit. We've already talked about we're buying one at the money. That's what a lot of people will do. I'm talking about probably with the put spread, more so than with even the call spread, is I go a little bit out of the money. And for the out of the money ones, we're looking at buying around a 36 delta, all right? And that's kind of where we started out. Then when you sell these two other puts out of the money, we just have to figure out, if this 36 delta underlying, and I'm paying like $3 for it, let's just say. Well, if I'm paying $3 for it, the strikes I'm selling, I need to at least get $1.50 for them, right? Because if I'm selling two of them, then that's $3. That finances my long put. And ultimately, what happens is, we did the 36 delta, that we get the width of this spread, that's the width, right? Well, that width of the spread, we get paid for that. And that basically puts our break even way down here. Our break even is going to end up being hopefully very close to a 16 delta. And as we know with delta is the probability of being 1 penny in the money at expiration. So it's only a 16% probability that that'll happen. So we've got good probabilities in our favor that our break even won't be breached. So even if we put this stock, right, there's only a 16% probability our break even is going to be hit. So I might put this stock just slightly higher than where my put is. And if it does, then I got the whole width of this spread. My break even's way down here, and I bought this, in a sense, that's where I bought the stock. If you add in your break even from all the credits you received, right? So synthetically, you would basically be able to buy it. Your break even is down here. That's kind of synthetically where you ended up buying it if you got put the stock. And it might be at a point where you weren't otherwise able to buy it. Does that make sense? I'll give some examples here. We'll show as we go along. Could you clarify again the delta choice and the break even? Slightly confused. Yeah. I'll do it. Let me go through these break evens, and it might start solidifying a little bit better. All right. So our max profit is the long strike plus the short strike, right? So let's just say XYZ is trading. We're going to just say XYZ is trading at around 100, just to make this a little bit easier. It's trading at $100 right now. So my long strike, I'm going to say, is just slightly out of the money. And this is just, pulling numbers out of the hat. So let's just say the long strike is 95 puts. And then my short strike is the 90 puts. All right. So those are the 90 puts. So what happens is my max profit is the long strike minus the short strike. So that's $5, right? Plus I said on a $5 wide, we're going to look to try and collect around 60 cents. So that's my max profit, which equals $5.60. So I get to keep that, right? Now remember, we're short an extra put here, right? I'm short an extra 90 put. The idea on the max profit is if it settled right there at $90.01 at expiration, the underlying settled at $90.01 at expiration, both my puts would expire worthless, right? My 95 puts would be worth $5, and I'd get to end up keeping that credit right there. So that would be my max profit potential, is that $5 plus the 60 cents equals the $5.60. Well, remember, my risk is this extra 90 put, right? Because I've sold 2 of those. So if the market started trickling down, we're looking at like 95, 90, 85, 80, right? So if the market started out at 100, where it currently is, and started trading down, I got my 90s, all right, or my 95s. I start making money all the way to the 90s, all right? So I made that $5. That's an extra $5 in my pocket. Well, that extra 90 put, I start losing on it, right? So once I lose $5 on that 90 put, that puts my break even right here, right? Because I made $5 here, and that 90 extra short 90 put didn't hurt me, but then the market continued down to the 85s. Well, I made this extra $5 here, and it starts losing on that down drop from there to there. Is that a little bit better explanation? All right, so our max loss is that short strike, that extra short put. This is the extra short put, that's my extra short put. Minus your max profit, right? Your max loss. So we talked about that. So in the previous example where I was talking about it, my max loss on this trade would be, from 85 all the way down to 0. All right. Because I bought the stock XYZ. This is where I got long the stock at 90 because of that short put. Stock got put to me, meaning I got long at 90. All right. So I got long XYZ at 90. So I'm long at 100 XYZ at 90. All right. So that's why, I lose $5 to here. That was my long put spread. My break even is down here. So that's why I was saying synthetically, because if I bought it at 90 and it reverted back, well, my break even was down here. I synthetically bought it at 85. I might have never been able to buy it at 85. That's where I may have confused people. But since my break even's at 85, that's where I synthetically bought it because of all my credits. If it goes to 0, that's my max loss. But won't the loss be 2 times the $5 with the short put legs? No, because remember, if I bought one put, sold one put, that's the defined risk strategy, right? Because remember, when you're long a put, you have the opportunity to put someone that stock. So yeah, I would be putting, I would still make that money, or actually you'd call the stock away from somebody because I have the put. So I could say, I want your stock at 95. I want your stock at 95 where I bought a put, sold 2 there. Somebody put the stock to me. Well, I got somebody's stock. If I got short or put the stock here at that 90, I still make that money because I can just offset it all. I got to look, if, say for instance, it's trading 80, right? Somebody put me the stock, I'm long at 80 or at 90, sorry. Somebody put the stock to me, I'm long at 90. Well, I can put the stock to somebody at 95. You put it to them. You have the obligation to, or at the 90th strike, you have the obligation to fulfill the contract. Here, you have the right, but not the obligation. Okay. All right. So we talked about the max profit or max loss. We got that. And I think I've covered this on the break even, right? It's basically the short strike minus the width of the spread is your max, and minus your max profit, because your max profit is going to be a credit. That drops it even lower. So when we were talking about this being $5 wide and this being 60 cents, and my short strike, I think I was saying was 90, right? So my 90 puts, short the 90 puts, minus the $5. So that puts me at $85 minus the 60 cents. So now my break even in that previous example is $84.40. Okay. So here's one of Apple that I just pulled up today, and here's what I was talking about getting us to one standard deviation, right? So 16 delta, or somewhere right around that 16 delta, is something that is very close to a one standard deviation move on the bell chart. If you remember from like school, if you were ever graded on a curve, we're trying to flatten the curve right now. Well, that's because they're trying to get the standard deviations of the people that are dying further out that curve, flattening it out. All right. So let's look at this one. We've got, and I did this before the close, right before the close, because I want to go over a couple of things with you guys using this example that doesn't usually work very well after the close these days. But here's my 1x2, right? So I'm looking at the 275 puts right here. So the 275 puts, that's about as close to the 36 delta. We're usually going to have to get closer to at the money than further away, but it will work further away as well, especially right now with really high volatility. We've got that $15 wide. So this is the one I bought. I bought these puts, and then I went down to the 260s, and then I sold two of those puts, right? So we're looking at this. Where's my break even on this? I've got this spread. I've got a $1.70 credit. So my break even is the 60 strike minus the width of the spread, which is $15. So basically just below this strike right there, 45, right? 45 plus the $15 width. Look at that. It's right there around that 16 delta. All right. So that's what we're talking about with the width of the spread. All right. The width of the spread minus the short put, which is that extra short put. I make money $5 or $15 all the way down. So as that market comes all the way down to that strike, I make that money. I make that difference, the width of the spread, just like a long put spread. Your max profit on a long put spread is the width of that spread, right? Minus your debit paid. Well, with this one, we're getting a credit. So we get the full width of the spread value, all right? Yes, we do have a short put on there. So in a sense, if, Apple traded down and I was like looking at the chart and saying, hey, I'd love to buy Apple at 260 because on the chart, it looks really good. Here we can pull up a chart. But think about it. That's where you would want to buy it. But because if you were able to buy it here and say the market traded all the way down to $2 or $250, right? And then started rebounding and going back higher. Well, my break even is all the way down here at 245. That's synthetically where I bought it because, we talked about it in previous webinars, lower your cost basis on the stocks you own, right? Well, if I just got a $5 credit on this spread, I lowered the cost basis of what this stock is that I own. So yes, I do still own it at 260, and it's going to show up in my portfolio as me owning it at 260. But when you look at all the credits that you've accumulated for this, well, I've got an extra $5 or $6.70 in that account. That's a nice dividend. Or saying that I just lowered my cost basis on it by $6.50. So if you lowered your cost basis on it, that's, lowering your cost basis really just means you're lowering your break even, which is kind of like, you can think of it also as that's where I bought it in a sense. How did you get the break even at 245? Well, because remember, we bought 275s, right? What's the width of the spread? 15, right? So if the underlying went from 275 to 260, that's $15, right? So that is a credit. I'll get that full credit, right? Because as we do it, just like a long put spread, you get that distance, you get the width of the spread minus the debit paid. Well, we don't pay a debit in this strategy, so I get the full $15. So this is the one I bought, and then I sold 2 of these puts. Well, I get the width of the spread, and I get to keep that, the original one, right? Because I bought a put here, I bought a put, and then I sold 2 puts. All right. So once that underlying goes down, this is the put spread I get to keep the $15 on. This put I'm losing money on as the market goes down. So, once it goes, it went from 260 to 255. Well, I made $15 on this spread. Now I'm only up $10, right? My profit is only $10 there. Here it's only $5. And then once we get to 245, that's where it's zero plus, I'm leaving out the credit. It's really my break even on this strategy right here. My break even is going to be $15, the width of the spread, $15, the strike, sorry, 260. Because that's where I'm long. 260 minus the $15, minus the $15, and minus the $1.70. Right? So really my break even is lower than where I was saying. It's 243.30. Is that better? 238. No, 243, right? Right. $15 from 16 is 45 minus the $1.70 is 243.30. Right. Okay. So that's how I came up with it. I was leaving out the credit on that one. All right. So some of our keys to success in building this out. I wouldn't say go out there and just do anything like AutoZone, all right? Because AutoZone's really wide. Now, if you guys have been watching the daily market commentaries, or you guys remember me doing the webinar on last week, and I was talking about EA Sports. Well, EA Sports markets option montage has gotten really wide. It made it very difficult. I ended up getting that spread, and I talked about that in the daily market commentaries. But the spread with or the option montage, the markets were just terrible in there when I was trying to do it. But I was able to get it for a 60-cent credit, just like I was talking about in the webinar. And but I got better strike locations, and the market's starting to rally. I'm more than happy to get out of my EA Sports at these all-time highs, or these 52-week highs that we're seeing. And at the end of the day, I'm gaining on it. It's upside. So it's kind of like I added stock at those all-time highs and didn't take a whole lot of risk for it, right? So you can do that for this as well. If you think it's a big pullback near the lows, well, if it goes I want to buy it way down here because the stock has been decimated, is your thought process here. And if it goes down further, I want to be able to add some more. I want to do some dollar cost averaging on some stocks that I own higher, before all this stuff happened. That's how you lower your cost basis also, right? If you bought it at the highs back in, let's say, January, and all this stuff happened, and now you're looking at it at the lows, well, it might be a good opportunity to add some stock to that long position. And this is a great way to do it, because you can take advantage of some downside, right? If it continues down, I can buy it at a really good level, and I make up money if it on that downswing rather than just going out there and selling puts. We'll be able to go out there, make some extra money on the pullback, and get this stock at a really great level. Yes, what's Wally saying? Yes, lower put strike minus the spread credit, but I think your side did not say a credit. It said max profit, I think. What's that? I was trying to do break even here, I think. Is that what we're talking about? Oh, are you talking about way back here? Yeah, I might have confused somebody on this one because I went back to the slide that I had. I was trying to talk about break even on this because I had already set that all up. Hopefully, by the end of this, we'll get through this together. And I'm going to even pull it up on the Analyze tab. We'll do that too. All right, so picking the right underlying. This is, this rule has worked out for the last 10 years. And of course, now with this extreme volatility going on, it's gotten a little wanky. But normally, what I would say is that if you're underlying, if XYZ, I don't care what stock you're looking at, if XYZ is trading less than $100, okay, this is a rule of thumb, it should be the bid offer on our option montage should be less than or equal to about 10 cents. All right. So right now, what I would say is that's a green light. All right. That is a full on green light. And a yellow light, what we'll say for this is, just to get my coloring going here. So I would say if it is somewhere between, if it's between now, on stocks less than $100, somewhere between 10 cents and 20 cents, that's kind of like a yellow light. You need to make sure you're going to be patient with this, and all of the other things work out to where they're green lights. All right. So for my rule up here, less than, just to make it clear, less than or equal to 10 cents is our green light. All right. A red light's going to be like 30 cents on a stock that's under $100. Now, if XYZ is, oh, great. I've kind of finally figured this thing out a little bit. If I draw straight down, it does not like it. Wants to flip. If XYZ is greater than $100 stock, then what I used to say is, well, and I still do, is take the decimal point. So if it's a $250 stock, take that decimal point and move it 3 ticks to the left. So it should be less than or equal to 25 cents. All right. That is the green light. All right. And a yellow light is basically somewhere you're going to double it. So times 2 is a yellow light. And I've been playing around with this and it works out pretty good. So times 2. So my yellow light would be, on this example, 50 cents. Right? So $1,000 stock, a couple of dollars wide. Especially if you're newer to trading. If you've been around the block and you guys have been trading some options and you're used to trading it, this rule is for really newer traders. All right. Eileen, I see your question there. I'm going to get to it here in just a second. But for instance, for the example that we were talking about here, this is Apple again. And what I'm talking about here is we would move the decimal 3 cents, so 28 cents on this one, right? So I'm going to look at these options, the ones that are closest to 35 days to expiration. So we want the ones, the monthlies that are close to 35 days to expiration. These are 28.9. That's going to be our best ones. The monthlies, right? Because that's where the most eyeballs are. So 28 cents is my rule. So we're going to look down here in the just out of the money options on the calls and the puts. And you can see that this pretty much fits that rule across the board, just slightly wider than that. But like I said, in this day and age, you can go, make it a yellow light, multiply that times 2, and we'd be looking at 50 cents. So that's your rule of thumb on this one. Green light follows those first rules, less than $100, 10 cents wide, over $100, move the decimal 3 ticks. That is green light. Times 2, that makes it basically a yellow light. So as long as it's falling in that perimeter, then we're good to go. All right, so does IV matter? Yes, you are trying to get ahead of me here. I'll talk about that in just a second. I have a trade that I need to increase the price of my long put, as I don't think that the underlying will drop enough by expiration. Do I need to do a call back ratio spread? Eileen, reach out to me on at the end. I'll show you my email. You can reach out to me. I'll dig into that. We're opening up a can of worms. I'd be more than happy to talk you through some of that, what I think we can do to manage some of that risk, but I don't want to open that can of worms right now. We all good? We good with that? Here's your environment, Banu. Yes, ID does matter. And when I'm talking implied volatility percent, it matters. We are going to have to figure out a few things here, but we want IV percent to be high. All right. And we want this we expect it to go down, right? So right now, we've seen this massive explosion in volatility recently. I mean, it is flatlining what we've normally seen for the past 5-10 years, all right? Where we've seen normal, nice, pretty range-bound IV percents for each individual underlying. Well, that's gotten blown out of the water, all right? So we do want high IV. We want that expected IV to start to go down as well. So what I say with this is implied volatility percent. We want IV percent, to be above 50. We want implied volatility percent to be above 50. And the easiest way to come up with this is we take where the current IV is, and this is implied volatility, current implied volatility minus the low implied volatility. We take that sum and divide it by the high IV minus the low IV. All right. So, we can pull up a chart here. Let's just look at Microsoft for lack of a better one. All right. So what we need to do is kind of ballpark it on this one. But basically, you know where the high is. It's right around 95. You know where the current is. It's 46. And the low is right around 16-ish, right? So basically, we take the current minus the low. So we've got 30 in the numerator and divide that by the 95 minus 16. So we've got 70, right? Oh, sorry, 80. 80. So 30 divided by 80, that puts us somewhere in around the 40th percentile. And pull up my calculator. Oh, it's underneath my questions box. So, right, so I said we've got the current, which is 46 minus the low, that's 30. So we've got 30 divided by that difference of 80. And that, what did I do? So we got the 30 divided by 80. And that puts us, I said 40 percentile. It's about the 37th percentile. So it's a little low, right? It's not my 50 IV percent I was looking for. If you expect volatility to go back to normal, like we go and pull up this chart like this and block out what we've seen recently, you can see that normally implied volatility for Microsoft was in a pretty tight range all the time. And that was pretty consistent that it would get up above 30, that it would want, or if it got up in the 30s, it would want to revert back, right? So we are in the middle of a black swan kind of event where now we are well 15 ticks above 30. You know, this used to be the extreme highs, right? So right now, you know, we're in an unprecedented area. Plus, I would expect this volatility to start going up around the earnings because that's what we normally see. So another thing is, I wouldn't probably implement this strategy tomorrow around Microsoft because of these earnings, right? I expect volatility to go up. I have better earnings trade. I would wait till right before the earnings in order to do something like this if I wanted to take advantage of that volatility coming out, because ultimately we want to do this in high volatility and have that volatility come out. You know, if you were able to build this strategy at a level where you were comfortable going through the earnings, and I would be happy to buy that stock at that level, then yeah, you can definitely do that for this strategy. Just know that you're taking the risk that you might be buying this. All right, the duration. Because we're doing it for a credit, anytime we're doing something for a credit, you guys, we want to get inside of this, you know, 35 days to expiration area. Because we want all of our premiums to come out, right? Like I said, we want that, in that one example, we want those 90 puts to expire worthless. You know, that way I just get to keep the credit. So ultimately, we want to take advantage of theta decay, and that's theta decay is going to come out as the days go on. One thing to note, the reason why we want it in high implied volatility is because if we got into that high implied volatility environment, what vol does is it kind of pumps up the premiums here, and it kind of comes out during that time. That's why I said we get the expectations of volatility coming out. You know, we get fatter than normal premiums than just what this is showing here. You know, we don't want to limit the theta decay way out here. Yeah, you're giving yourself a little bit more time to be right, but you know, I would be just as happy to get the credit and then, you know, do this trade again, you know, another expiration out. Continue to, you know, take this strategy. All right, well, it expired worthless. I got to keep the credit that I originally did it for. Well, I'll just do it in another expiration cycle. All right, continue to sell that spread in something that I'd be willing to buy, right? But why go way out here and just have to wait for the end of time for this to work out for you? So we want to get in close to around that 35 days to expiration because we want all this theta decay happening. Yes, right now we're kind of right in here, which is good. We're inside of this wheelhouse, which is what we want. You know, if it starts getting inside of 14 days right there, then that's where I'm going to be looking out here at around the 40. I'd be looking at the 45 days to expiration, something like that if it got inside of there. You know, as close to what we can get to this 35-day mark is what we're looking for. So what's closer, 14 days or 45 days? It's the 45 days. All right, picking the right strikes. Like I said, if it's less than $50 wide, if we're looking at less than $50 wide or $50, it's going to be about 50 cents wide. All right, and it's somewhere between 50 and 100. You should be looking at somewhere from about $1 wide. Sometimes with high volatility like we're getting right now, you can get it out to about $2.50 wide. And if it's greater than $100, then you know you're going to start at about $5 wide. All right. You know, my what was it? My Apple. You know, that was basically $250. Well, we were looking at $15 wide. And that's, you know, pretty in line with what we're looking there, right? $100 wide, $5 wide, $200 wide, it's about $10 wide. You know, you can continue to scale it like that. All right. Everybody with me so far? So that's the thing to do this. And picking the right strikes equals a credit. I mean, star that. Don't do this strategy without getting a credit for it. It doesn't make sense. And we kind of already showed this. We were talking about this right here, half standard deviation. That's where my 36 delta is, you know, and my break even is all the way out here at a 1 standard deviation. If you do the standard deviations, you add up all of this, it's going to be very close to 16-ish. So with my spread, I'm buying it in here. This is where my short puts are, right? I'm short 2 puts, I'm long a put here. Well, and then this is where my break even is on the bell curve. The 1 standard deviation move. So if we're doing this for a credit and the market stays up here the whole time, well, that's, you know, that's about an 84% probability of a winner, right? If we get to keep a credit, an 84% probability of keeping that credit, that's a winner. There's this, you know, there's a small probability that it's going to go below here, and that's where it starts, you know, below this break evens, where it starts to be a loser. But that's pretty good probabilities, you know. If I was looking at just doing the naked short puts, you know, this is basically, if you guys watch those webinars on implementing options into your portfolio, that's kind of the strike location I look for just selling that short put. Well, you know, I'm probably getting about the same credit at the short put at the 16 delta as I would be with this spread on the put spread with the credit. So the strike locations ends up being about the same. Maybe just a little bit more aggressive. The distribution is slightly confusing. I'm not sure what you mean on this. When picking the right environment, can you please explain the formula you wrote at the side? Yes. Where is the 16 delta? And the 16 delta is here. Because look, if we had 9.2 plus 4.4, that gives me right around 13.6 plus 7, or 1.7, that's 14, 15 point something plus this, right? That ends up being close to 16%, right? And 16% is thus 16 delta, right? Remember, minus 1 is right here. So, you know, this bar, the 9 plus that, plus this, plus this, plus this, plus this, plus the minus 4 standard deviation out here, plus that, right? So this is a 16% probability of happening. And why is it 16% probability of happening? Because remember, we go back to delta, and delta says that there is a 16% probability of finishing 1 penny in the money. So everything below it is 16%. That makes sense? All right. Cool beans. All right. We're going to run out of time almost. All right. Knowing your exit strategy before entering the trade, I look at it like this. If you're doing this just as a trade, we're looking at 30, and the people that higher risk tolerance, 30 to 50% of max profit, right? So I was looking at that one where my max profit, it was $5 wide in the, or $15 wide in the Apple, right? $15 wide plus the $1.70, we're talking $16.70. So somewhere between, you know, that $8.35, right? That's just off the top of my head, and 30% of that $16 is going to be somewhere around $5 and 50 cents or something, just off the top of my head. So somewhere between $5 and $8.30. So if my spread started getting there, I was doing this just as a trade. That's where I would look to get out of it. If I didn't want to take possession of this underlying. All right. If you want to implement this into your portfolio, you just need to write it out. Okay. You're just going to take this home with you. You're going to fill it and bill it. Take it with me. All right. You're going to kind of forget about it. That makes sense? Everybody with me? All right. So let's take a look at an example here. All right. Pull this over. Let's see if we can do that Apple one again. Hopefully, you'll see the markets are going to be really wide now. Because, it used to be nobody would cancel their orders. Now, after the close, look at this. So we can take a look at Apple. It's maybe $3 higher than where we were. I'll pull up my other, let me see if I can find it real quick. Oh, no, I want to go this way. So this is why I took a screenshot of this right before. The difference, I mean, yes, we moved a little bit at the end of the day, but look how tight these markets are. We're fitting my rule easily, 10 cents wide across the board. But after the close, that's why you need to look at this during open market operations. After the close, these markets have blown up, right? A lot of people canceling their orders after the close. Think about it when you put a trade in as a day trade. As soon as that bell rings, you just hear cha-ching or and everything's getting canceled. So isn't the 16 delta a probability, 16% chance of being in the money as where the break even would be? Yes, I think I read that correctly. So basically, our 16 delta or whatever we were looking at, now it's a little bit lower here, but on the deltas, because it rallied a little bit since the close. But yes, what this strike is saying, the 145 strike is saying with delta is in the next 29 days, or on May 15th, this strike has a 12% probability of being in the money. That's one of those, it's a floor trader hack, really, to be honest. Delta also tells you how much it's going to, how much this is going to be, valued for every dollar move in the underlying. So it's assuming a dollar move higher. These are, if this underlying moved a dollar higher, 12 cents would come out. Okay. But a floor trader hack is that it's delta is the probability of being 1 penny in the money at expiration, right? Market's up after hours. Oh yeah, it's up an extra $2 from even the close, isn't it? All right, so we were looking at this. We're going to be looking at like the 38 delta, because I said you're usually going to have to go a little bit closer. So when you pull this up, you're going to pull this up as a buy, right? Now, $11, that's what I'm paying for it. So one of the easiest things to do, $11.30, is to go down here in the option montage and say, where can I sell it in order to get that $11.35? Well, now if it's $15 wide, it's a debit. Don't do it. So I would rather go and say, you know what? I'm doing the 80s. I'm buying that for $11 or somewhere. That's pretty good pricing. I'm probably going to have to do it at the 260s. Still a debit, probably. So I'm going to have to do it $15 wide. Thought I would be able to do it. I thought I'd be able to get it for at least a scratch. So that's what you're doing. You're kind of playing through it, see where your strike location is, and do that for a credit. Yes, you could go, all right, I want a little less risk on this. Maybe it's because you were looking over here and saying, okay, well, I want to buy it at 260. You know, that's kind of where I want my break even to be, because you're looking at Fibonacci or whatever, maybe a volume node or something. So you're saying, all right, well, 260 is where I want it. So that gets me my credit, right, of $1.20. That puts your break even below that level we were just showing. All right. So well below it, as a matter of fact, but you would be assigned it at 260. So I would be willing to buy at 260. But my break even, remember, is $15 lower than that. So we'll go over to the analyze real quick. And then go to analyze this trade. Get rid of whatever that is. All right, so we can see here, if the underlying traded higher, you know, I get to keep that spread. I get to keep that $1.20. That's my profit. It never goes below the zero mark. All right, so the current underlying is here. Actually, no, the current underlying is trading here. If the market traded down, you can see my max profit is at that 260 mark. It's a little funky on my thing. 260 is where my max profit is. Now, as the market starts trading down, that extra put, I got to keep the $5, you know, just like as the market went down on that put spread, where my put long is, the 275, I start gaining in value all the way down till it hits 260. Then I start losing money as it goes all the way down, and it should come in right there at 80, 243.80. I can't nail it, right? Because that's the $15. Every downtick now, all these dollar downticks are eating away at my profit that I used to have. All right. But my break even's down here. Yes, I bought it at 260, right? But think about it. I got that $15 credit from the put spread. I got long at 260, but because of this put spread, my break even's way down here. So even if the market hit me on my 260s, I got put this stock, came all the way down to 250. And then the market started rallying again. Well, I got long at 260, but I also got that put spread that expired at full boat, $15. You know, that $15 is in my pocket. How long would you hold this trade for? Well, Trevor, like I said, for this strategy and for this webinar, I'm saying implementing options into your portfolio. This would be, I would want to buy Apple at 260. I'm looking at the charts and I'm like, oh man, I missed out on, you know, I was afraid to buy it here. Now it's rallying. You know, I want to get it. I want to buy this stock because I think Apple's going to do well. Once people come out of this and start going back and shopping, they're saying people, when they get out of this, are going to go gangbusters at shopping. Yes, they've been doing it online, but, you know, getting out of the house and going to the brick and mortar or whatever, they're going to be going to Apple stores. You know, maybe you're thinking, I'd love to buy it at 260 or something like that if I get a pullback. I don't want to buy it here. Or, you know, Netflix is my one that I'm really kicking myself, even though I was touting it all the time. But look, it's got a bit of a top going on. I might be saying, hey, if I can get Netflix on a pullback, I'd be happy to buy it. So you do this strategy, you're going to be getting in at around, well, we could look at it. Even though the markets are going to be super wide, you know, 40 cents wide is what my rule is. Yellow light would be 80 cents wide. During the open market operations, it might even be right now a little bit wider than that, but it's pretty close. So right around the 36 delta. So I'm going to go right at the 36 delta, see what we can do. $25. I got to finance $25. So I could probably do the 290s and get a credit for it, right? So it's $30 wide. So my break even on this is 360. So that's almost way down here at the point of control. That's lower than point of control with the 360s and the credit. So, you know, I'd be happy to buy it on a pullback. I'd be getting long at my short strike, which is 290, right? I'd be getting long up here at 290, but my break even's way down here because of that big fat credit I got. What if you don't want to buy Apple? If I don't want to take Apple into my trading account, then I'm looking at 30 to 50% of my max profit. So my max profit's 15 plus the 6. That's what I think I was talking about with that 30 to, I don't know where I wrote it down on one of these things somewhere. Is it here? So 30 to 50% of max profit is what you're going to look at if you don't want to take it into your account. Right? So it was $15 wide plus the dollar something. This is a ballpark. So if you have a lower risk tolerance, I would be looking at doing $5.50 or something. That's 30% width or of max profit, and 50% would be right around that $18 or sorry, $8.35. Cool. All right, guys, probably the last week we're going to be offering this. This is premium option education. I remember at the beginning of this, I talked about, hey, you don't have to watch this necessarily put ratio spread. You can go out there and watch one of the other ones. Well, this is the premium membership. You get mentorship with this. Like I was talking with Eileen, reach out to me. You have a question about a trade that's like going against you. How do you manage that risk? I'm more than happy to reach out and answer any questions via email. And if I can't do it in an email, I'm going to say, hey, let's jump on the phone. Let's hop on the Skype. Let's like work through this and figure this out so that you are clear of concepts. So you get that. That's not in here, but that's part of the offer. You get the daily market commentaries where I talk about all my trades, when and where I'm putting them on, win, lose, or draw, how I'm managing my own risk. You know, I've got trades that are going against me, and I'm trying to manage that risk as well. So I'm in the same boat as you guys with some of these things. You get the trading workshops, which are real quick ones. So like if you didn't want to watch the entire long webinar, I've got real quick refresher courses. So you kind of just go over the rules real quick. It's kind of assuming you already have watched one of the other ones, and access to the webinars and other premium membership offers there that you can see there for, you know, $97. I see your question, Andreas. I'm going to answer it in here in just a second. So here's where I'm talking about with the different option courses. If you're newer to options, you can go over to the beginners, check those off. Like if you wanted to look at the long put, because you were bearish in something and not so bullish in this environment, you could start looking at the long puts and it will check it off. Hey, you watched this one. And then you can check it off in a different option course as well. That'd be like watching it again when I was talking about watching it again. So for this strategy, you know, maybe you're looking at, want to rewatch the put ratio spread where I talked about this. It's different scenarios, different questions being asked. I may have forgotten something in this one that I covered in that, you know, so keep that in mind. Just like when I was talking about the call ratio spread, how do you implement that into an IRA? I probably covered that there. So you basically get access to all of these webinars. By the time you get done with this, you guys are legitimately going to have like an MBA in trading this stuff. So take advantage of it. The offer is up there in the window. I'm going to throw it out in the chat window because I forgot to push this out there just a second ago. So why won't you let me push this out? There we go. It's in the chat window. So that's a hot link. If you pull that, hit that thing, it will pop up in your web browser, just like this one. You can just kind of scroll through it and check out everything that's in this. Click on add to cart and you are good to go. All right. So take advantage of this. Like I said, we're not going to be offering this probably past this webinar. So if you haven't done it, treat yourself to some cool listening and watching these videos. And if you have issues in your account that you need to work through it, you can feel free to reach out to me and we'll take care of you. All right. So I'll try and get those questions that was asking. Eric, can you please explain how do you evaluate the implied volatility to see if it is good for this strategy? Yes, we'll go back over that. All right, so let me see. So what we want is, the idea here is, right, when volatility is at extreme levels, all right, one thing we know with implied volatility is that it dictates what the premiums are over here in the option montage, okay? So volatility is Vega. If I scroll this down, you'll see that, if I hover over this, see how it says implied volatility? That's what it is. Right now it's 75. So see, that's that number. It's quoting the spot month, which is why I say go to this one. This is where everybody's looking at. This is what everybody's quoting. This is where all the eyeballs are. So 75.94. So that number doesn't mean anything at all, because I can go over and look at, GE or something. It's 95, right? That doesn't tell me anything. 95 Google's 44. Is that high or low? That's what we're trying to determine. Is that high or low? Well, 44 for Google is kind of like middle of the road. We were looking at, what was I looking at? Apple. Apple 47. I don't remember what the other example was that I just had up there that was 75. But what we're trying to do is say, where is this implied volatility right now in relation to where it's been in the past? Because where it is right now tells me then if premiums are high or low compared to where it's been in the past. Well, no, it wasn't as high as where they were at those extreme levels, which is why we're going to have to play around with this little bit of a rule that I have on, high implied volatility percent being above 50%, right? Because you can tell, this last couple of months, it's extremely high. Well, if you expect this kind of volatility that we've been seeing to continue for, through, summer, then we need to stick to this idea. You think that, well, this is just a black swan event that happened and it's not going to happen for another 50, 100 years, then we might have to, in the future, discount that move. But right now, we're going to keep it in play. So we're looking at it. How is it in relation to where it's been in the past? Well, it's pretty high from where it's normally at, but we're in unprecedented times. So we want to kind of still correlate it to where this is the extreme high. I doubt we'll see volatility really spike up there again for Apple, but we still need to keep that in the back of our head. So we say, all right, 48 is where it currently is. The low here is 20, right? So we take 48 minus probably 18 actually is the low. 48 minus 18, so we've got 30 in that numerator. And we divide that by 100, let's just say for easy math, 100 by 18. So we've got 82, right? So 20 divided by 82 should put us somewhere at about 25%. So another easy way to do it on Thinkorswim is they actually give it to you. It's 35%. I must have done my math a little bit wrong in my head. But you get what I'm saying there? Did I explain that? So if it's above 50, it's a good strategy. Why? Because we did it as a credit. And if we do something as a credit and volatility goes down, so for every 1 percentage point, this goes down in implied volatility. So if it goes from 47 to or sorry, 48 to 47. Well, we know these premiums are going to decrease by the Vega coefficient. Every 1 percentage point decrease in this, then we lose 30 cents because it's a positive number. Well, it means it's expecting, when we look at these, everything is based on an increase. Delta is an increase in the underlying by $1. Gamma is an increase to the delta. Theta is an increase every day. You can't gain a day, right? So that's why it's negative, because every day increase, we're going to lose a penny. And then for every percentage point increase, these premiums will increase by that percentage point. Well, if it goes down, we have a negative plus a positive, which means it's a negative to the premium, right? So if it goes from 48 to 47, it loses 1 percentage. 1 percentage plus a 30 is a negative 30 cents to the premium. Does that make sense? So that's why we want it high, because the expectation is that it's going to revert back to the mean. We always expect things to kind of come back to the sweet spot, right? Which is why I like that market profile, and I teach how to trade in the market profile if you're in these, taking advantage of this as well. Because market profile, things want to revert back to where it's comfortable. All right, cool. All right, take advantage of this because it is the last time, and for 97 bucks, you get a mentor out of it as well. It's a lot of bonuses in there that I didn't even talk about. You can ask us, reach out to us at protraderstrategies.com or email me. Somebody was asking about the email, so here I'll throw the email real quick. I don't have it on there. Where's the email? Trading at protraderstrategies.com, which is the easiest thing right there. So I think it was Eileen. Reach out to me at trading at protraderstrategies.com. And if you have any comments, questions, or future webinars you want me to do, reach out to us at 310-598-6677. All right. Also, go over this disclaimer. We are an educational company, and we are not trying to give investment advice. All right. That's all I got for you, other than if you can't take that, take it easy. Bye for now.